Hey everybody, I hope everyone's doing well and had a good day. This is the Emini end of day review for Monday, August 19th, 2024. Before I get into the review, I want to touch on bad signal bars leading to support and resistance. And I didn't really plan this out and I don't know how long it's going to take. So I will put in the description of this video what time I actually start the review. So if you're maybe pressed for time and want to just get to the review, I'll put that in the description. But otherwise, you can stick around and I'm going to talk a little bit about bad signal bars. But first of all, in order to understand what a bad signal bar is, we have to know what a good signal bar is. And that's kind of the fundamentals of price action. And you can read about it in Al's books, or you can watch videos in the video course. It's one of the first few videos. Al talks a lot about signal bars. He gets into it. And the basics are that bears want to sell below bear bars, and bulls want to buy above bull bars. And the strongest types of signal bars are reversal bars. So for example, on today's chart, a good signal bar for the bulls, a good example is bar 34, 46, 49. And then for the bears, good signal bar 5, good signal bar 9. So if those are good signal bars, what's a bad signal bar? Well, it's the exact opposite. So the worst types of signal bars for those traders, it's the opposite. The bulls, it's a bad signal bar if you buy above bar 9. For the bears, bad signal bar selling below bar 46. And then there's everything in between. So there's kind of a spectrum. And the more the bar is closing above its midpoint, near its high, and then preferably with a tail, the better it is for the bulls. So bar 14, it's a bull reversal bar. There's a bull body, but it's basically a doji. It has a very small body, so it could be better. That's why a bar like 34 is stronger than 16. This is strictly signal bars we're talking about, though. This is not even context dependent. And then the opposite for the bears. So the bears, bad signal bar to sell below a bar like 49, a good signal bar. A better signal bar is 48. It's a bear reversal bar, even though it's basically a doji, small signal bar, or small body on the bar, but closing below its midpoint, so better for the bears than selling below a bar like 49. But again, that's always context dependent. So I wanted to talk about two quick examples of yesterday where bad signal bars led to breakouts, and the bad signal bar, the signal, so in this case for the bulls, the high of the signal bar becomes support, and then for the bear case, the low of the bar becomes resistance. So what I'm talking about, for example, if you look at bar 6 on this day, and we'll go back as if it's in real time. Okay, we see maybe 2 or 3 legs up to the moving average. Bar 1, pause, bar 3, pull back, and then up to bar 5. 3 pushes up, and then a bear bar at the moving average. Some bears, they'll sell below this bar. For the bulls, probably not ideal to buy above it. It's a bear bar closing below its midpoint. Trading range bar, probably sellers above. And therefore, you probably have bears selling above bar 6 and bulls hesitant to buy above bar 6. It's not an ideal bar to buy above on a stop order. And then we got bar 7. And 7 was a surprise bar. It's a big bar. It's a breakout bar, closing far above the prior bar's high. So what just happened? Bar 7 trapped traders. So you have bears who sold above bar 6. So if you imagine you're a bear, let me see if I can draw this quickly. You're a limit order bear, and you sell above bar 6. And your argument is 3 pushes up to the moving average. You look to the left, big up, big down. We're probably in a trading range. Yeah, we might be in the middle. We could turn down here. If we do go higher, I can scale in higher. And, this part is kind of irrelevant for the conversation, but let's just say you scale in somewhere higher, like at the top of the trading range somewhere, and you're using a wide stop, some kind of measured move up. So here's your stop. No one's actually going to risk that much, but just for the sake of the argument. So you sell above bar 6. Bar 7 is your entry bar. You look at bar 7 and you say, darn, that's a really terrible entry bar. It went really far against me. It closed above my entry price. So maybe you scaled in during 7. Maybe you'll scale in on the next bar or wait to see what happens. But if you're a bear and you sold above bar 6, you're clearly disappointed with bar 7. So we'll make a horizontal line, the theoretical entry price. You're short here, the market rallies and closes here. So what are you going to do if the market retests the high of bar 6? If you're lucky, if it comes back down and tests it, you're going to get the heck out of your short. The market's probably going to get a second leg up after bar 7, and this is the reason. It's trapped traders. Bears sold above, they're trapped into a bad short. There's now support at this price level. At the same time, remember I said I had to pause there for a couple of minutes, so I hope I'm picking up where I left off. I think I talked about the bear case, and now I'm talking about the bull case, where I know I mentioned the bulls see 3 pushes up. We're all below the moving average, all the bars below the moving average. Bar 6 is a bear trading range bar. You can call it a bear reversal bar. We went up, we closed below the midpoint, but there's a tail below. So probably a lot of trading range price action on the bar. You go to a smaller time frame, this bar probably went up and down, up and down. It's a trading range, and you know that traders in a trading range buy low and sell high, so probably buyers below, sellers above. And there's less of an incentive in this context for the bulls to buy above bar 6. So the bulls are not buying, the bears are selling, and then we get bar 7. So now what happened to the bulls? The bulls see the distance the market went. We broke out a fair distance, and it's close to a 10-point breakout, maybe 7 or 8 points. All of a sudden, there's this breakout that the bulls missed, and they're not going to buy when the market's at the top of a trading range. They're going to buy on the retest of the bad signal bar, maybe the breakout point, the bar 5 high. So now you have bears who are looking to buy back shorts at the bar 6 high. You have bulls who are trying to buy to initiate new longs at the bar 6 high. You have bulls who bought lower, who rode that breakout. They're looking to add on a breakout pullback. And what does that lead to? Leads to an imbalance. So now we have support at the bar 6 high. Bar 8 comes back down. You can see we retest the bar 6 high. We might have broken out 1 tick below it. So anybody who had an order to buy or sell at the bar 6 high had their order executed. The market went at least 1 tick below it. What's the expectation from here? Big bull breakout, sideways for a bar. So breakout, pause, expectation, another breakout to the upside. Bar 7 likely strong enough for a second leg. We know there's support at the bar 6 high. So bears not too eager to sell here, but they'll sell higher, and the bulls are willing to buy here, look to take profits higher. And then we got another leg up, and then what happened? Top of the trading range, we get a reversal down. The other example I wanted to talk about on this day was bar 51, I believe. So look at bar 51. Same exact thing, but Now we're going to talk about a bear breakout. And it's actually not the greatest example. Bar 7 was actually a better example, but this is going to do for this video. Bar 51. It's a bull reversal bar closing on its high. So that's just about the worst signal bar the bears can get. And again, I don't want to get into the context discussion. That's an entire different video. I would have to make a video on that. But the point is, context does make a difference, and context is always more important than the signal bar. So yes, you can argue we had a rally, and then we're pulling back, maybe 2 legs up, testing this possible climactic late leg. We might be late in a trend. This was an exhaustion gap. We closed the gap. 2 legs up, double top with bar 42.51. I see the argument selling below it. But if you just play along with me on this example, bar 51 is a bad stop order signal bar for the bears. So the bears, they don't really want to sell. The bulls, they'll buy below the bar. Then we get bar 52. If a bull bought below 51, they're disappointed with their entry bar. Even though it closed above their entry price, you got a bear trend bar for your entry bar. And if you're buying below a bar, you want a bar like bar 4. You think about the bulls who bought below bar 3. Actually, that's a great example I could go back to. I'll talk about that one after this one, and then I'll go into the review. But right here, so 51 bulls buy below the bar. Disappointing entry bar. They'll probably exit, look to buy lower. The bears see that the bulls are disappointed with their entry bar, so they might sell. And then we get a downside breakout, crossing the moving average, strong enough for a second leg down. A bull had to be really quick to avoid a loss on this trade. We don't know how quickly bar 53 sold off, but we do know that there's no tail above the bar. Very little overlap. Probably 80% of bar 53 is not overlapping the prior bar. So it's a pretty decent breakout right there. So what happened to the bulls? If a bull bought below 51, arguing it's a micro channel, 4 bars up, 45 to 51, I'll buy below the bar, worst case, use a wide stop, scale and lower, and 4 bar micro channel, bull, reversal bar, probably buyers below for a second leg. It's a reasonable trade. And then they get trapped on 52.53. Now the bulls are disappointed. They'll use any rally they can get. Just ask yourself, what would you do if you bought below bar 51 and you got 52.53? If you're still long at this point, regardless of if you scale in, you look to the left for a breakout point, look for a bear bar, whatever it is, maybe you scale in a little bit lower. But even if you don't scale in, if you're long and you get bar 53, the logical thing to do, this is probably getting a second leg down. Traders are trapped and sufficiently disappointed. There's probably resistance at the bar 51 low at this point. And then what happened to the bears? 51, yeah, possible double top, but bad signal bar, maybe wait for a better signal bar. This is why this example isn't quite as good. The bears actually got a reasonable signal bar 52, and traders sold below it. But you also have bears who did not sell because 51 was the signal bar, 52 was the entry bar, did not close below. So bears, this wasn't the cleanest sell setup. You also have maybe 20 bars above the moving average. It's a moving average gap bar. There's probably buyers here for a couple of reasons. However, on a retest, you have trap traders above. Bulls are looking to sell out of their losing long positions around the 51 low. Bears are trapped out of a winning short position. They're looking to sell around the 51 low to initiate new shorts. What's the result? 54 vacuum test of resistance, and then immediately we got a second leg down. And you consider the context, that's probably a scalp, probably buyers below 53, and probably going to go more sideways. Now, one more good example on this chart that I just saw. Bar 3 is actually a great example of what I'm talking about. Bar 3. So you think about what Al talks about with the bare minimum. There's a minimum for everything in trading. Like, in order for your trader's equation to be positive, you have to go for at least 1 times your actual risk. And sometimes your actual risk is really small. And so taking profits at your 1 times actual risk, it's really not optimal. It's profitable and it might work, but a lot of times it might not be the thing you want to do. That's just the minimum. He talks about it in this way. Do you want to strive to get D's in school? Of course not. It might be the minimum and you'll pass the class, but nobody wants to strive for D's. And the reason I'm saying all of that is because of bar 3. Bar 3 is a sell reversal bar. It's closing below its midpoint, but it's basically a doji, and it actually has a bull body. It's a bull close. So bar 3, it's a sell reversal bar, but it's not a bear reversal bar. So for the bears, it's a reversal bar. There's a big tail above it, and sure, you can sell below it. And again, my mind always goes to context, and the context really doesn't support the stop order sell here either, below 3. But if we just focus on the bar 3 signal bar alone, we can say, okay, the bears have a signal bar. It closed below its midpoint. It's a gap down, bar 81 plus the gap down, leg 1, probably going to get a second leg down. And now we have a low 1 short below bar 3. So you have traders selling below bar 3 on stops, and then you have bulls. Maybe they'll look to buy lower, maybe on a test of bar 1. And then what happens, obviously, any trader who sold below 3 got trapped into a losing short position. However, the market's in a trading range. So if you don't panic, you see 3 pushes up, testing the top of the range, good reversal bar. Maybe you sell below bar 3, sell more below bar 11. See if you can get out at break even. And just one more thing between that. Before you get out at break even, maybe you can exit break even on the entire trade. So what I mean by that, at first I was talking about exiting break even at your original entry price. However, if you scale in, this is how you increase your probability. You sell below 3, you sell more below a strong bear bar, 11, you exit at the midpoint of the 2 entries. What happened on bar 14? We tested that average price, and then traders bought. But then you had a micro channel, and this is a sort of a bare minimum bull signal bar, probably more sellers above, micro channel, strong enough breakout for a second leg. This was a parabolic wedge. You're expecting 10 bars and 2 legs. There's your second leg, and look where we tested. The bar 3 low. Stop order bears trapped, and then they get the retest, and then you can see that price became support, and we had to go much higher before we found sellers. So I hope that was helpful, and I will get into the review for today. So again, this is the Emini review for Monday, August 19th, 2024. And we'll start with the weekly chart. If TradeStation will let me. So coming into the week, we had a good, let me back up actually. So we have a bull channel, trendline break. The expectation is a retest. Here's a good bull reversal bar, even though it's kind of a doji. It is a reversal bar. It's a bull bar closing near its high. And then a good entry bar for the bulls, probably going at least a little bit higher, but you probably also have bulls disappointed to the left, bears. This is a great example as well. Look at the sell signal bar from the week Give me just 1 second here. This is a great example of what I was just talking about. The week of July the 12th, it's a bull bar, and it looks like it closed at or above its midpoint. It's a bad stop order sell signal bar, but then you got a good entry bar and more follow through. So you have trap traders above. Bulls who bought below this bar arguing it's a tight bull channel. I can buy below a bull bar. Worst case, I scale in lower, stop below, probably make money. Bears, they don't sell below. They're looking for a better signal bar, and they're trapped out of a good short. So here the bulls are trapped into a bad long. Bears trapped out of a good short. The expectation, so the breakout, finally comes to an end. That's a really sizable breakout. We've retraced almost this entire third leg, depending on how you look at it, maybe 1, 2, 3. Overall, looks like a big trading range. Big up, big down. The expectation is sellers above, but if this is a trading range, the bears maybe they don't want to sell above a bull reversal bar, and they don't want to sell in the middle of the range. They might prefer to sell at a breakout point, like a bad signal bar low in this case. Maybe they'll sell at this line. Maybe the bears won't come in until a new high, maybe the close of the bar. Somewhere up here, we're expecting resistance. Now, the retest so far is stronger than the bears would have liked. And you can see the weekly bar last week. Very strong bull trend bar, small tail below and above, basically opening on its low, closing on its high. Very little overlap with the prior bar. That's a strong enough breakout for a second leg. We're probably going at least a little bit higher. The danger for the bulls, we might be high in a trading range, and even if we do break out to a new high, it might be a wedge. 1, 2, 3, and this might be a climactic third leg. I did have this line drawn, thinking maybe there'd be resistance here, but you can see today the market closed above that price. Actually, let me just double check. I'm sure it did, but this is the Globex session. So here's the day only session chart. So pretty much the same thing. We closed above. And then for the daily chart, here we are coming into the day. Here's what we see. I mentioned on the weekly chart, big up, big down, probably a trading range, 3 legs up, 2 or 3 legs down, climactic, maybe a second leg trap, final flag, strong bull, reversal bar, bull trend bar, outside bar, and then look at the follow through. This is good follow through, and if you compare the buying here to the selling all the way down, this is much different than this. Look over here, bear breakout and then a bull bar, bear breakout, bull bars and sideways, and then a huge climactic bear breakout. And you compare that to the bull breakout where it's much more orderly and contained in a really tight channel. This is a breakout on that higher time frame, as we saw on the weekly chart. We had a good buy signal bar down here, and then the past 5 bars, which were here, 1, 2, 3, 4, 5, that's last week. It's a bull breakout. It's a bull breakout on the daily chart as well, but it's comprised of 5 bars. And we saw on the weekly chart just one big breakout bar. The point is, the strength for the bulls is stronger than the strength for the bears on the way down. Big moves like this are not always good, especially in a trading range. It's climactic, it attracts profit taking, and it will attract the opposite side, aggressive bulls, to start buying. So coming into the day, if you're looking at this chart, you would say the market is always in long. We have a strong bull breakout. It's adding more and more bars. We've had no pullbacks, lots of good bars closing on their highs, little overlap. We're probably going higher. If we fall below yesterday's low, probably buyers below. The bears, it's very likely the bears need at least a second reversal to reverse this bull leg. This leg is very likely to get a second leg up. The bears will see a double top, but again, the bears don't want to sell below a bull reversal bar. after maybe a 7-bar micro channel with all bull bars, and most of them closing on their highs with very little overlap. So we're probably going at least a little bit higher, but there might be resistance above August the 1st. And then just one more thing, I mentioned always in because when you think about always in, the analogy I learned from Brad, he talks about locomotives or an aircraft carrier. When the market's always in and it's in a strong trend, it takes a lot for the move to reverse. This isn't the greatest example because we are in a trading range, big up, big down, big up, lots of overlap. So no matter how strong a breakout looks, it can fail. But in this example, you compare this bull breakout again over here to the bear breakout. There's a pullback, very climactic. And then again, orderly, good bull bars, not that climactic. This is much harder to reverse than this. And so if you think about this as a locomotive or an aircraft carrier, it takes a lot of time before you can reverse this. So this bar alone, probably not enough. Even if the bears get a good bear bar, probably not enough. The bears will view any bear bar, any pullback, as a pullback instead of a reversal. They'll see it as a minor reversal. They'll buy for a second leg up. So coming into the day, with that said, trading range at the end of Friday, maybe a wedge, 1, 2, 3 pushes down, and then we had a bull trend before the wedge. So the bulls, they see bull trend, wedge, bull flag, and then maybe we're getting the breakout of the wedge, bull flag. Bar 1 is already breaking out of yesterday's high. By the way, when I say yesterday, if it's Monday, I'm referring to the prior trading day. So if I say yesterday, here I'm talking about Friday. So bar 1 broke out above the prior day's high, Friday's high. And that's to be expected. When you look at any chart, most bars are breakout bars. In other words, most bars are not inside bars. And so the expectation, and because charts are fractal, markets are fractal, that applies to any chart, any time frame. So if it's a 5-minute chart, it's the same as a daily chart. So if you think about the top-down analysis and why I like to talk about the weekly chart and then the daily chart, and then I'll get into the 5-minute chart, it's because I get a grasp on what the higher time frame charts are doing. And it's always important. Yesterday's high and yesterday's low, those are some of the most important areas of support and resistance coming into a day. And that's because most days break out. You have probably 80% of the time, maybe even more, you'll have bars. You'll have the day try to break out above the high of the prior day or break out below the low of the prior day. And as traders, and as traders who read price action, it's our job to try to figure out, is it more likely we have buyers above yesterday's high or sellers above, or buyers below the bar, sellers below the bar? We already said there's probably more buyers below. Here's what we see on the daily chart to the left. It's a 6 or 7 bar bull micro channel. It's a good bull signal bar. The market's still in a breakout. So traders are buying for any reason, strong bull trend. So you will have traders buying above this bar. The upside might be limited, might be big down, big up. But the point is, with this much momentum and this kind of a signal bar, the bears are probably not all that interested in selling directly above the bar. Maybe they'll sell at a measured move up, or even a half a measured move up, but probably not directly above the bar. So coming into the day, bar 1 breaking out above Friday's high, maybe breaking out of this wedge bull flag. The bulls, they're hoping the breakout succeeds and we get a measured move up of the bull flag. The bears hoping for the opposite. This is all a trading range. We have a bull trend, trend line break, higher high major trend reversal. The bears are looking for a sell setup here for a major reversal. Look at the approach for the retest. So if this is a major trend reversal setup, which it is, the bull trend and the trend line gets broken by a lot of bars. At this point, breakout direction might be 50-50. But then look at the approach here, the past 5 or 6 bars, using the day only session chart. It's a bull micro channel. We have a lot of bars to the upside with very little pullbacks, very little overlap. There's micro gaps. The bears need at least a second reversal. They're probably not going to sell below the first bear bar, and they're probably not going to sell below a bull bar like bar 1. Bar 1, we have not a lot of information. You're expecting a trading range open, and most days, 80% of days, have trading ranges on the open. So for a lot of traders, it might be best to step aside and watch the first 6 bars or so. You're expecting a lot of reversals for breakouts to fail. So even though there might be more buyers above yesterday's high, it's very common to see failed breakout attempts first. Remember, the market's always trying to trick you. And if you think a breakout is likely to succeed, it's going to try to convince you that it's failing. But keep in mind, decent micro channel here. Maybe bar 1's a little climactic. It's the first bar breaking out above yesterday's high in this entire trading range. So the big bar and the location might attract profit taking. There might be sellers on the close of 1, above 1. However, probably buyers below 1. Buyers at a 50% pullback of this micro channel. And then bar 2. You can see what happened on bar 2. Here's the micro channel. The market pulled back to about 50%, fell below bar 1, and there were buyers below. Now for bar 2. Remember what I said in the beginning of the video. Bar 2 is a buy reversal bar, but it has a bear body. So the bulls look at bar 2 and they think that's a bad signal bar. It's a high 1. The bar is big. We're possibly at the top of a trading range. We might have a higher high major trend reversal. I better not buy above bar 2. Rather wait and see what happens. Maybe buy below 2 or maybe even lower. But maybe I'll wait for more information. The point is, bar 2 is not a very good signal bar for the bulls. So if it's a bad buy above bar 2, that makes it a good limit order sell. 3 rallied above 2 and then pulled back immediately. Now at this point, the bears, they have a micro double top with bars 1 and 3 and a double top with bar 42 and 3. 3, just like the opposite of what I just said, bar 3 is a bar, it's a sell reversal bar, closing below its midpoint, but a decent bull body. Not an ideal bar for bears to sell below. So you probably have traders looking to buy below 3, although maybe not directly below, maybe at a distance, maybe a measured move, maybe at the moving average. But this is a bad sell signal bar, so bulls will buy and scale in lower. Inside bar on 4. Now at this point in the market, we've had 4 bars into the day, and every bar overlaps the other bar. So bars 1 through 4 all overlap, and now bar 4 is an inside bar. So we have 2 legs up to the top of a moving average, 1, pull back 2. Now we have an inside bar. We even possibly have a major or a head and shoulders top on a smaller time frame, left shoulder, head, right shoulder. This is a lower low. Inside bars, the breakouts of inside bars probability is reduced. The odds are there are sellers above 4. The bears see the inside bar as a breakout mode pattern. The market is contracting. Somebody's getting squeezed, and when you look to the left, we might be high in a trading range. The bears see the inside bar as a reversal setup, so they might sell below 4. But the bulls, they see a bad stop order sell below 4. They'll probably buy below, scale in lower. And then 5 was a good bar for the bears. Bear bar closing on its low. It's a bear breakout. Closing below the past 2 bars will probably go at least a little bit lower. But at this point in the day, and with yesterday or Friday, bar 80, 81, and then through bar 5, all of the bars have been completely above the moving average. So at this point in the day, we have a bull regime. It's more bullish, and that makes sense. We look to the left, and we have a possible bull trend, wedge bull flag, and possibly continuation. Expecting a trading range on the open. So bar 5, it's a strong bar for the bears, and then a possible major trend reversal with, on this time frame, maybe a head and shoulders top, double top 42 and 3, and then a good signal bar. So bears, they might sell below, but the concern is that the strength of the retest of the old trend's extreme was too strong, and there's buyers below. 6, we went a little bit lower, we tested the moving average, and then we bounced. 6 for the bulls is a high 1, or in this case, you actually might call it a high 2. We have a rally, high 1 on bar 2, and then a high 2 on bar 6. It's a high 2, but look to the left, the market is either in a trading range or a bull trend. And what that tells you is that the market might be in a broad bull channel. And you trade bull channels, broad bull channels, just like you trade a trading range. Broad channels are basically trading ranges that are just sloped. So what do bulls do here with the high 2 on bar 6? Don't bulls buy high 2s at the moving average in bull trends? Yes, you can. And it's a reasonable trade. You can buy above 6. Use a stop below bar 76 on Friday. However, we might be at the top of a trading range, and the signal bar could be better. You're following a decent bear bar, probably trap traders above, probably traders selling the 50% pullback of bar 5, which it looks like bar 6 tested, also testing the high of Friday. So 5 was strong enough for a second leg down, so there actually might be more sellers above 6. Bulls can take the high too, but if the bar hesitates and they don't get a great entry bar, maybe like bar 1, they'll just bail out of the trade, look to buy lower. And then we went more sideways on 7. Outside bar on 7, it's an outside bar in a trading range. There's not that much to do with that information. It's a trading range within a trading range, we know that. Probably sellers above, buyers below. Very tight range from the low of bar 2 to the high of bar 3. Very tight trading range. The odds are breakouts will fail. 8, we're getting a bull breakout attempt. It's a good looking bull bar, but there's a lot of overlap. You look how much bar 8 overlaps the prior bar. About half the bar overlaps. We actually did not close at a new high. We just poked above the new high. And now traders see 3 pushes up. 1, 2, 3. Climactic third push. Even here, it might be a wedge on a smaller time frame. Up on 6, pull back. Up on 7, pull back. Up on 8. So here, there actually might be sellers above, and I just mentioned tight trading range, probably sellers above, buyers below. Breakouts will likely fail. 80% of breakout attempts in trading ranges fail. So a good bull bar at the top of the range is more of a sell to close bar. 9, we reversed. We went a little bit higher and then got a good sell signal bar. It's a bear reversal bar closing near its low. The context is good. 3 pushes up, top of a range with room to the downside. Bulls can exit below 9 and stop order bears can sell. There might be a brief second leg after bar 8, but the upside here might be limited, and it's dangerous to be buying below bar 9. And then bar 10, we had a good bear breakout bar. But the problem for the bears is context. So we have a possible expanding triangle on the open of the day. 3 pushes up, 2 pushes down. That's 5 legs. That's the minimum for a triangle. In this case, it's expanding. We're getting higher highs, lower lows. Bar 10 could simply be a vacuum test of support. What's it testing? Well, we look at Friday. Sell the closed bears on bar 76 got trapped, and they never got a chance to get out. And what's bar 10 testing? It's testing that area. And then you can see the bear channel line from the expanding triangle, just about the same price. That's a dueling lines pattern. So for a couple of reasons, we're expecting support in this area. So even though bar 10 is a huge bear breakout bar, let's also pay attention to a couple of other things In respect to the overlap, sure, bar 10 does not overlap bar 9 by very much. 90% of the bar is actually below bar 9. But how much of the bar is breaking out below the bar 2 low? Or how much is breaking out below 76? Well, maybe 40% is breaking out below bar 2, and 0% it's not breaking out below bar 76. So huge trend bars in trading ranges are really dangerous. And what I mean by that, it's easy to get trapped into selling big bars like bar 10, even though in some ways you look at it, there hasn't been a breakout. There's been a breakout below these bars, but it's all minor. Until the bears get a breakout down here, this is a minor breakout. What the bears are hoping for here is a major trend reversal. Bull trend, trend line break, higher high, double top, major trend reversal. If bar 11 looks like bar 10, traders will be convinced, yeah, this is a major trend reversal. And the bulls got to get out, the bears will sell. But the bears need one more bar. They haven't even broken out below this swing point. And then look at bar 11. When you're in a trading range and you get these big bars and, the bears need one more bar, they usually don't get it. And that makes bar 10 more of a buy the close bar. And then we rallied on 11 and retraced a lot of the bar. 11, for the bulls, it's a reasonable stop order buy. It's a double bottom with 76 and bar 10. And the expanding triangle argument, plus it's a good signal bar on bar 11. So you will have bulls buying above 11, bears getting out. If you're a bear and you sold at close of 10, you're probably desperate to get out at break even if the market will let you. But if you just sold low in a trading range, you might not get that chance, and then follow through on 12. So for the bears, 12 is a problem. The bulls are getting follow through on the reversal. It's a good reversal up, big down, big up. So sure, we're high in a trading range, but when we think about day structure and the higher time frames, we know the odds were there's buyers below yesterday's low, which is all the way down here, and there actually might be buyers above the high, even though on the open we're expecting a trading range and more sideways. Breakouts typically fail. The market wants you to believe breakouts are failing, so here's a breakout attempt, several breakout attempts of yesterday's high failing, but the bear reversal attempt is now failing. So this is a failed failure. The bears were hoping the bull trend resumption was failing, and now the failure is failing, and we're getting trend resumption to the upside. So it's probably always in long, and you can buy the close of 12, buy above 12, and at a minimum, the market is looking for a mission move of the opening range. I had the wedge bull flag drawn earlier. Here's the first target, maybe right here. More follow through on 13, so now we have a 3 or 4 bar bull micro channel. 13 is a bad stop order signal bar for the bears, even though it's a double top with bar 9. The momentum is too strong. The first reversal down will likely fail. Buyers below 13. Bears need a better sell setup, and so bulls can buy for any reason and hold and just get out below a reasonable stop order bear setup. Inside bar 14. Continuing to the upside, there's an implied pullback on a smaller time frame. We pulled back, sold into the close of 13 and down into the open of 14, but then reversed up. And on this time frame, there's been no pullback. This is still a micro channel. For the bulls, it's a high one buy and a leg one breakout. And it's reasonable to buy. For the bears, really nothing to sell. The selling pressure has not been great in here. 15, we broke out to the upside, but then pulled back. We have this channel line drawn above. The bears are hoping it holds, and there's resistance at this line. We get another reversal. And over here, it looked decent for the bears. There's a lot of overlap. Good signal bar, 9. The bulls not really getting it done over here. Actually, this one was fairly strong, but these are just minor pushes. But over here, the bulls have a new always in leg one reset. This is still a micro channel, and this is kind of the locomotive analogy I was making earlier. It's not the greatest, but this is a better breakout than bars 9 and 10. Really, bar 10 is the only bar breaking out, bar 9 actually was a bull breakout bar. But bar 10 is the one breakout bar for the bears, and it's big and it's price control, but there's no time control. It's just one bar. As opposed to the bull breakout, the bulls have now controlled price and time for 5 bars, and this is strong enough for a second leg, whereas this could easily be a vacuum test to support and a bear trap. 16 getting more follow through. So we're at the channel line, but it's a 7 bar bull micro channel, and the signal bar is a bull bar, probably buyers below, and a minor reversal at best. And this bull breakout could get a measured move up. At least bars 11 and 12 takes us near the wedge bull flag, and then maybe the bulls get the breakout all the way from bar 11 to 16, and that takes us closer to the opening range measured move. We're getting the bull breakout on 17, so the market wants to go higher. Bar 17 reached the wedge bull flag measured move. Now, 17 is a climactic bar. We had big bars here, big bar, but then smaller bars through here, and then suddenly acceleration. And why are we accelerating? There's probably more than one reason, but one reason is we're testing this measured move target. So you can see the market got vacuumed up to that measured move. Everyone is in agreement here. This price is too low. The bulls are buying, the bears are not selling. We have to go higher to find sellers. And after a micro channel of this magnitude, the odds that the first reversal attempt leads to a big bear trend is probably 20%, maybe even less. It depends on the context, but here, the odds are the bulls can buy anywhere, even the close of 17 at a measured move target, use a wide stop, be willing to scale in lower, and you'll probably make money. You'll at least break even on the trade 80% of the time, and in this case, maybe even more. The problem for the bulls on 17 is that it's a surprise in the direction of their trade. So if a bull bought 11, 12, anywhere down here, you get this acceleration. You're going to have bulls taking profits at this measured move. You're going to have bulls taking profits just based on the momentum, the fact that this is accelerating to the upside. It's a 6 or 7 bar micro channel. If you study micro channels, you'll see that most micro channels reverse or pull back after 6 or 7 bars. So once you get to that range of 6 or 7 bars, and then you get this momentum, it might be a good idea to take at least partial profits and protect your profits, and then maybe look to buy again lower. Or if it's continuing to exhibit strength, you can buy again. But in any case, 17 probably at this point more likely a measuring gap than exhaustion. We're only about 7 bars into a bull trend here. And if this is going to be, well, this argument might not hold up. I was going to say a leg 1, leg 2, where this is leg 1, this is leg 2. So that makes sense. Here's a leg 2 measured move. There is still room to the upside. And we're fairly early in this bull leg, so 17 more likely to be a measuring gap, which I drew from the low of bar 10 to the high of bar 16, the breakout point of the gap. That takes us up here. I'm going to get rid of this one. I don't want to have too many lines on the chart. And you can see the market's not paying attention to this bull channel line. I'll keep it for now. Maybe we'll retest it, but I will get rid of that soon. The market's not paying much attention to it as it was over here. So bull breakout. Most breakouts pull back. We're at a measured move target. We'll probably pull back. So the problem for the bulls here is that if you've been on the sidelines, this is not the greatest place to buy because bulls who are long are going to take profits. Bears can sense the acceleration, 6 or 7 bar micro channel. They'll sell for a scalp. We may pull back. Now, just because you can make money scalping against this counter trend does not mean you should. Your goal as a trader is to make money, and it's not to take trades. So you don't have to take all the trades you see. Even if you see these minor reversals and scalp setups, it's okay to see them, and it's also okay to say, I see that setup and I pass on it. Because in this context, it's much easier to make money buying. And the market's always in long. It's better to actually be holding a position long here with a wide stop, willing to scale in lower than to sell here. We paused on 18. 18 is a high 1 implied pullback, high 1 inside bar. It's a doji, but the momentum up is strong enough it's reasonable to buy above 18. But because of the exhaustion, the bulls might see this as disappointing follow-through. Bulls who bought the close disappointed. Maybe they exit and look to buy a little bit lower on a pullback. But it's still okay to be long. Still always in long. The bears have no reason to sell. 19 continuing higher. Double top. 17, 19 maybe. But if you're looking for reversal setups in this context, you're going to lose money. This is a continuation pattern. There's probably buyers below 19, and you can buy above 19, but we may pull back first. Inside bar, 20. So going a little more sideways for the bulls, it's a spike in channel, 17, pullback, channel, testing the top of the breakout, usually sellers above here, which there were, and then we got an inside bar. There might be sellers above, but any reversal is minor. 21 bear bar closing on its low, but that's the expectation after a spike in channel, then a trading range. So according to the market cycle, 17 breakout, 18 pullback, the start of the channel, and then we rallied in a channel on a lower time frame. It's more obvious. But the expectation, channels evolve into trading ranges. So the expectation here is a bear breakout, not a bull breakout. We get the bear breakout, and then there's probably support at a couple of areas below. There's the bar 18 low, the start of the channel, which, if you can imagine it, is very similar to this right here. Here's a bull breakout from bars 1 and 2 and up to 3. That's a bull breakout. Doesn't look great, but it is, from the low of 1 to the high of 3. Then there's a pullback below 3. That's the start of the channel phase. So spike, pullback, bull channel. The channel expectation is a bear breakout and a test, or channels evolve into trading ranges, which we got. Channel, trading range, testing the start of the channel, you're expecting support, and either a bull leg in a trading range or a trend resumption. So it's the same thing here, just on a smaller scale. Bull breakout, pullback, start of the channel, here's the channel, the expectation is the trading range, but there might be buyers. On a smaller time frame, there might be a setup like bar 3 here at the low of bar 18 here. Bear breakout, probably strong enough for a second leg, but minor reversal. Bulls will buy it just because it's a bear bar after such a strong micro channel. It's okay to buy it, and it's reasonable to buy anywhere when the trend is this strong, but you have to use a wide stop. The theoretical stop below bar 11. Bad follow through, you can see. We tested the low of bar 18. We also came close to this bull channel line, and depending on how you draw it, we might have actually tested it, overshot it a little. Depends on what you draw, but close is close enough. So you know there's a couple of areas of support right there. So we bounce, but 21, 22, strong enough for a second leg. 22 is a weak signal for the bulls. It's a micro double bottom with 18, so it's a high 2. But the signal bar is a doji. It's following a good bear bar. We might need a deeper pullback. This might need more of a correction. Bull reversal bar 23, good for the bulls, but context could be better. This might be a brief small second leg before a deeper pullback. Maybe we'll test the breakout point of bar 16, the high. Maybe we'll test the bar 9 high, the moving average. But still okay to be long. This is a minor reversal, and there's really no reason to be short. 24, small bear bar. Bad follow through for the bulls, disappointed. Might be going sideways here. The odds are this is a flag, a bull flag, until there's 20 bars in the trading range. Any sideways in a bull trend is a bull flag, which you're expecting a bull breakout. So any breakout here, within it or below it, likely minor. Outside bar 25, but 2 legs up, testing high. It's a minor trading range here. This spike in channel, it's minor, but then we went down, we went up for a couple of legs. It's an outside bar, Might be at resistance. Last time we were here, nobody was buying. We got 21. So we might get a double top, at least a double top attempt. 26. Inside bar, it's a bear bar. For the bears, they will see it as a double top with bar 20 and 25. The signal bar is decent. The worst thing about it is the context. Beginners love setups like this because the risk is very small. You risk to above bar 25. You sell below 26. Your risk-reward profile is great, but your probability is terrible. 1-to-1 gets you to the moving average, where there's probably buyers if we do get there. But a beginner, in order to take this trade with the risk-reward, well, I should say with the probability it has, you have to swing. So if you're selling here, stop above, your reward is really down here or way down here, the bar 10 close. You're betting on a trading range day. But after this is the dominating feature of the day. Strong bull breakout, it's very big. The expectation at this point is either a bull trading range day or a bull trend day, maybe a bull channel. So low probability sell, and that makes it a decent buy. Limit order buy below. Traders will also buy below 20. That's the neckline of the double top, but the double top in this context is not a reversal setup, it's a trend continuation setup. So bulls will buy below at the neckline, betting the breakout will fail and we'll get a reversal back up. 27, bad entry bar for the bears. If you sold below 26, that's a bad entry bar. And traders might give up above it. We could also continue more sideways, very tight trading range, probably buyers below, sellers above, but risky to sell above. Look how many bars are above the moving average. It's a bull regime. We've had one close below the moving average all day. Most of the bars are completely above the moving average. So it's always in long and probably a bull trend at this point. 28, we're going more sideways. The bears are hoping this is a final flag, tight trading range. Maybe it's a triangle. So bears hoping there's one more breakout and then we reverse back down. But we need more selling pressure. We have lots of open gaps at this point. Or I should at least say a big open gap. From the open, this is a body gap from the open of 9 to the close of 21. There's a big space, and that is all support, trap traders below. Bull breakout 29, but possibly 3 pushes up, depending on how you look at it. 1, 2, 3. And it might attract profit taking for the bulls. It's a spike in channel, and everything's fractal and nested. So we had a spike in channel here, and then this is a spike pullback channel. This could evolve into a trading range that eventually tests the low of bar 21 or 22. But again, if it is a trading range, you expect buyers below, and this is the neckline of the double top. So bulls will buy there as well, betting that the bear breakout attempt will fail. 30, big bear breakout bar, but it closed above the moving average. Big tail below. It's one big bar, and that's great, but it did not close below the neckline. So the bears are getting a breakout attempt, but the selling there is actually expected after 3 pushes up. Spike in channel, expecting a trading range, test of the lows. And also, if we look to the left, the breakout point, we didn't quite get there. But let's see. We have a breakout point here, the bar 15 high. 16 broke out above it. Why not use bar 13? Because 15 did not break out and close above, so I'm going to use 15 here. 15, we have a bar with a tail on top, and then 16 broke out above, closed above, and then had follow through. So that makes the high of 15 support. Any trader who did not buy above 15 got trapped out of a winning long. Any trader who sold above 15 got trapped into a losing short. Both bulls and bears are looking to buy a retest of this price. 30 gets there in a hurry, but overall might be a bull flag, a trading range in a bull trend with support below. So we vacuumed back down there, but look what happened on bar 10. big bear bar, but you need more than that, especially with such a big tail. It's really price control, and it could be due to bulls stepping aside as much as it is due to bears selling. Sure, bears might sell because it's 3 pushes up. You're expecting maybe 10 bars and 2 legs. At a minimum, maybe a test of the bar 22 low or the moving average. But everybody can see the major direction is to the upside. It's always in long. And yeah, we might pull back, so not ideal to buy here, but it's still okay to buy and be long, but use a wide stop. And then 30, obviously we're testing some logical support. So looks bad for the bears. The breakout bar did not close below the neckline, and it is rallying at support. Might be enough of a surprise for a second leg, but any second leg is probably going to be minor. 31 could be that second leg. We rallied into the close of 30, rallied on 31, and then sold off on 31. That might be leg 1, pullback, leg 2, low in a trading range at support, but not a good buy signal bar above 31. There might be more sellers above for a second leg down, but it's a bad low 1 as well, so buyers below. Inside bar 32. II pattern, that's an inside bar. 32 is inside 31, 31 is inside 30. And bulls will see it as a reversal setup and a trend resumption setup. Bull trend, trading range, low in the range, II, and a bull bar closing on its high. So not ideal for bears. Bulls can buy above. Really for a swing, your probability might not be great. Your signal bar is small. Maybe your stop is close, but the context is okay. 33, decent entry bar. We broke out to the upside, closed above the bar, and now 33 is a bad low 1. Sell signal bar, there's probably buyers below. And then we went outside up. 34. So remember, even though it's a sell reversal bar, it's a bar closing below its midpoint. It's got a bull body. The context isn't good for the bears. This might be all they get as a second leg. So there might be more buyers below 33. And then we went below 33, found buyers, and then reversed right back up. So 34, bull bar closing on its high. We're getting a tight channel to the upside. 34 closing on its high. 32 closing on its high. Overall, either a trading range or a bull trend. We're probably going higher. Sideways, 34 or 35. And we're in the middle of this tight trading range. We may start to go more sideways here. And we're getting close to 20 bars sideways. So the bears can argue breakout direction is becoming more 50-50. But the reality is, if you look at the buying pressure, if you compare the buying pressure to the selling pressure, even if you just counted the number of bull bars compared to the bear bars, how many bear bars have we had in the past 20 or 30 bars? Not many, maybe 4 or 5. And then there's open gaps below the overall context. How many bars are above the moving average? This is probably a bull trend. So if anything, better to be buying below bars or even buying above bars, but better to be long than short here. 36 continuing to the upside, tight channel, probably going higher. 37 pulling back, but bad signal bar 36. The odds are buyers below. Right back up 38. Retesting an area where bulls got trapped if you bought the close of 36. Disappointed 37. Maybe you exit at 38, but the bears still don't have a very good setup. The bears might be hoping for a major trend reversal here. Bull trend, trend line break, retest, maybe a lower high, double top, or head and shoulders even. Left shoulder, head, right shoulder. But not enough bars for a major trend reversal. And where are the big consecutive bear bars? The selling pressure. It's really not there. Plus this retest of the trend's extreme, a little too tight. Probably a breakout on a higher time frame, probably going higher. 39 continuing to the upside. The bears not getting good signal bars for sells. We triggered below 33 and triggered below 36, but both bars were weak stop order sell signal bars. And 39 is too, even though it might be rally, pause, rally, pullback, rally, 3 pushes up, top of a range. In a bull trend, it's okay to buy at the top of the range. 40 continuing. It's overlapping the prior bar by a lot, but it's a tight channel and it's reasonable to be long. And then a bull breakout 41. Remember the opening range measured move. So we have a vacuum on 41, very close to that price. We may get there on the next bar and then pull back. Is bar 40 exhaustion, or is it a measuring gap? At this point, we don't know, but we do know that the selling pressure is pretty weak, and it's not unreasonable that we can get here before here. So this might be a measuring gap, and until the bears show more strength, we're going to maybe lean more toward measuring gap. But if the next bar is really disappointing, it looks like 21, then it's probably an exhaustion gap. 42, bear bar, inside bar, but not like 21. It's really more of a sideways trading range bar. Bulls might buy it, strong enough breakout for a second leg, and support below. Bears who sold above 29 got trapped on 41. That creates support at that red line. And then 43, we fell below 42, but it's a low one after a decent bull breakout and a bull trend. Signal bar small, probability is low, probably buyers below going higher. 44, high one in a bull trend, tight bull channel, reasonable to buy, use a wide stop. And we are close to a measured move target, so there might be some resistance here. But up until the bears show proof that they're strong, we're going to assume any reversal is minor. 45, a bear bar. We're testing the breakout point, the 29 high. It might be a vacuum test and a second leg. 1, pullback 2. The gap closed, so it might be an exhaustion gap. We might start to go more sideways here. But exhaustion gap does not mean reversal. It just means the bulls are exhausted, and they might wait for 10 bars and 2 legs or some kind of correction before they buy again. But that does not automatically mean we're getting a reversal and the bears are suddenly strong enough to reverse the trend. There's not enough selling pressure. We still have open gaps. The body gap is still open at this point. Bodies of bar 30 and 45 do not overlap. So on the line chart, that's a gap. The line chart plots the closes of bars. So there's a space between the close of 29 and the close of 45. And it might be I forgot to mention this, the context is bad for the bears. I said it was leg 2, so it might be a second leg trap, leg 1, pullback, leg 2, at a breakout point. So 45, even though it's a bear trend bar, it might be a more of a buy the close bar, and then disappointment on 46. It's a high 2, high 1, 43, high 2, 46 at a breakout point, strong signal bar, context is good. Probably better to buy above this bar. Not ideal for selling. If you do buy, your stop does not go below 46. It goes below the recent bull leg. Inside bar, 47. We can still buy above 46. On the next bar, the bears are trying to continue lower, but this is more sideways than down. This looks like a bull flag. Outside bar, 49. The bears, again, looking for a reversal. Maybe a second reversal. We fell below 42. We fall below 47. We have an outside bar, but it's a doji. And we're testing this breakout point again. And what happened the last time we tested it? Traders were trapped here. And when we tested it, there were buyers. And if we test it again, there's probably going to be buyers. And that's what happened on 49. So 49 becomes a high 3 at a breakout point. Dueling lines pattern. There's a couple of reasons to expect support in this area. And the context is good. It's a bull trend, so you can buy above 49, 50. It's an okay entry bar. It's not the dream entry bar, but it's a lot better than a bear bar. It's not what the bears wanted. The bears probably won't sell below it. 51, continuing higher. Same thing. Not ideal, but the bulls are getting trending highs. They're getting trending closes, trending lows, trending opens, trending everything. So on a smaller time frame, this is a bull channel. It's a micro channel on this time frame, which is a breakout. The breakout's continuing, 52. The bulls are getting a lot of bull bars. It might be an endless pullback on some smaller time frame. This was a bear trend. Now all of a sudden, the market's just drifting higher. And because of the overall context, there's an increased risk that we get a bull breakout. 53, we're adding more bars to the channel. Lots of overlap within a trading range. So there might be sellers at the high. But overall, increased risk of a bull breakout than a bear breakout. 54, we're breaking out. We're breaking out of the neckline, and the bulls want a measured move to here. We reached the opening range, measured move on 54. There might be a bounce. We might stall. But where's the sell setup? Where's the selling pressure? Through here. So continuing higher, 54, probably going higher. Pause bar, 56. Probably not going to reverse this micro channel. Buyers below. 57, we fell. We're testing breakout point to the left, maybe here. We broke out. We're pulling back. And the odds are it'll become support. We'll get at least a second leg. 58, micro double bottom, 57, 58. It's a high one for the bulls. Outside up, 59. But at this point, we might be getting late in a trend. Maybe it's 1, 2, 3 legs up. We might start to go more sideways. It's not really a reason to look to sell, though, because still most of the bars are completely above the moving average. So this is still a bull market, and it's still always in long, reasonable to be long. And then 60, another bull bar. So lots of bull bars today, not many bear bars. The next target for the bulls might be this measured move. The next one after that might be this measured move. 61, another bull bar, 3-bar micro channel, tight bull channel, probably buyers below. Sideways, 62, not strong enough for a reversal, no trend line break. And then give up bar by the bears, 63. We're testing this measured move, this measured move. Is 63 exhaustion, or is it a measuring gap? It's one of the two. We know it's not a breakaway gap. This is not the start of the trend. The trend started down here. So 63 is either exhaustion or measuring gap. If it's exhaustion, we're expecting the gap to close, the market to come back down and test the high of 62. But even if it is exhaustion, doesn't necessarily mean reversal. If it's a measuring gap, we're expecting a measured move. The first measured move target here, the next one from down here, the next one all the way down here. But one thing at a time. We start with the most conservative targets and see how the market responds to them. So we'll keep that one for now. 64, so there's a couple of different ways to look at bar. 64. 63 is a good breakout bar, but the context, the bulls might be suspicious that it's an exhaustion gap. The bears are hoping it is, but there's still the chance that it's a measuring gap. So bull breakout and then 64. Bulls might see 64 as a bad follow-through bar. The bulls would have liked 64 to look like 63. However, the flip side, what do the bears think of 64? Is 64 strong enough to reverse bar 63? Probably not. If you were to sell below 64, put a stop above 64, you'd probably lose the trade. A little bit lower on 65, but still a big open gap. This looks like a channel on a smaller time frame, and bear channel means bull flag, bull breakout, pullback. We'll probably get a second leg. 66, continuing the channel down. Now we have a 3-bar micro channel. There might be a more complex correction with a second leg, sellers above 66, but still always in long, still an open gap. And then 67, we're continuing lower, so the gap is closing. We have what might be an exhaustion gap. 67, close the gap. So this did become an exhaustion gap. We got an endless pullback and a bear breakout. But now we're getting exhaustion in this bear channel. Maybe 1, 2, 3, 4 legs down. The biggest and strongest bar occurring on 67 at support, probably buyers. And then you can see more of a buy the close bar, 67. We bounced, but might be strong enough down for a second leg. The danger of trading this micro channel for a second leg is the context. You're completely above the moving average. These bars are still controlled by the bulls. They are completely above the moving average. They're probably more due to bulls stepping aside and looking to buy lower than aggressive bears selling. Also parabolic, climactic. The trend line got parabolic. You can see the lows here. So high one, but it's a double bottom, decent signal bar. You can buy, but probably use a wide stop. There might be a second leg, but the second leg is expected to be minor. Inside bar, 69. It's almost a triangle, and bulls see it as a trend resumption pattern. The odds are this is not a major reversal. There's no major trendline break. We're probably going higher. 70. Bull bar closing on its high. Might be enough big up, big down, big confusion for a trading range. Sellers at a new high, but we're probably going to test the new high. Bull bar, pause, maybe another bull bar, but then another pullback. It's a channel on a lower time frame. It's getting confusing. There's a lot of overlap, but still bull trend. Bars above the moving average. Outside bar 72. Failed breakout below. Failed breakout above. Still bull regime. Always in long. Probably going to test the high of the day at a minimum. But there might be resistance. Bulls who bought here. Endless pullback. They'll probably use any retest to exit their longs. The bears are hoping for a double top major trend reversal, but for that, you typically need a strong, well, you do need a major, or let me put it this way, you need the bears to break a trend line that is significant. And has that happened? That has not happened. We're testing the trend line, but we're not breaking it. And you typically also need a break below the moving average. So still probably a minor reversal. More likely we go up here than a measured move down. But we'll look at the measuring gap, measured move. Inside bar 73, IOI, breakout mode. Bears see a final flag, lots of sideways and overlap, but still a bull trend. Will probably go a little higher, but they're hoping this is the final flag, and any reversal, any breakout leads to a reversal. High 2 at the moving average, high 1, 71, high 2, 74. And the bears not really getting decent breakouts or consecutive strong bars. More of a sideways trading range and a bull trend. 75 breaking out above the high 2. Good entry bar for the bulls. Signal bar could be better. Whenever the signal bar isn't very strong, you need the entry bar to make up for it, and 75 will do that. There might be support. We might have to test the 74 high before we rally higher. So we tested it on 76, but probably support in this area for a second leg, and then we rallied on 77. We're testing that measuring gap, measured move. We might be testing this measured move. We're coming close to it. Maybe we get closer. Maybe we get to it. But 76 or 77 has the biggest chance of being an exhaustive buy climax, an exhaustion gap. The reason, there's a couple of things going against it. It's late in the trend, so might be leg 3, 1, 2, 3. It's the biggest bull bar that we've had all day since bar 11. It's funny, 11 was 11 points. It's the biggest bar, so 63, it was big, but not this big. So 63 was 7 points. This was almost 10 points. So it's the biggest bar. It's going to attract profit taking. It's a late leg, the market cycle. 3 legs up, you're expecting a deeper pullback. We're also getting late in the day, and it's common to get profit taking at the end of trend days. And this might be, if you think about it, if you're long and you see bar 76, you think, wow, that's a windfall of profits. I'll just protect my profits, take at least partial profits, but in this case, it might be better to take full profits and see what happens. 78 rallying higher to the upside, but still could be exhaustion. We are testing and breaking out of this measured move. We broke straight through it. By the way, this is a double top measured move. Even though it doesn't look like it, the theoretical double top is that the bears, there's a top here, then there's a retest that reverses. There was just no reversal here. We just broke straight out. So breakout and follow through, but still late in the day. More of a possible gift for the bulls, maybe profit maximization, but not ideal to sell, but just you're expecting a deeper pullback. 79, big up, big down, 2-bar reversal on a higher time frame. Good breakout bar, but bad follow through bar. It's a reversal bar, and it's a doji. And there might be buyers below, but this is disappointing for the bulls. We'll probably go more sideways into the close. 80, we went sideways, big up, big down, trading range, and then just more sideways into the close there. For always in, coming into the day, it's a trading range, so it can be dangerous to trade always in, but this rally was strong enough to make the market always in long, but top of a trading range again, really not ideal. Better to buy low, sell high. This is all trading range price action, but then you get this possible opening reversal, higher low, double bottom with follow through. It becomes always in long after big breakout bar, follow through, more follow through. This is not a good sell for the bears, even though it's high in a range. There's no sell setup, and then there's just no pullback, and we rally more. This is still always in long, and it's really always in long all day long. There really was never a place where the market became always in short. Stop order trades today. I thought the first best one was below bar 9, and then you could buy above 11, 12, 14. You could buy above 15, 16. Always in long, buy above any bull bar. You could buy above 23, 27, II 32. It's still always in long. Use a wide stop. And all through here, buy above any bull bar. High 2 above 46, high 3, 49. Those are reasonable. Testing the moving average in a bull trend. Maybe double bottom with 59, high 2, reversal bar, reasonable. Maybe don't take the first buy here above 69 or 68 because tight pair channel. You're expecting a second leg, but then you get the second leg sideways, and then maybe you buy above 74, 75. You get triggered on 77. And then for limit order trades today, I thought there were buyers below 1, sellers above 2. Sellers at a new high above 3 over here, maybe 3 legs and 3 legs. And then through here, there's been no pullback, so the first pullback will likely get bought. Buyers below 20. Bad high 1, 22, probably sellers above. Not ideal, it's counter trend. And it's a decent breakout. And then maybe 1, 2, 3. Limit order sell above 25, betting on a late leg. More of a correction. We'll test the 22 low, maybe breakout points. 30 is a bar that the bears are using to take profits, and they're barely avoiding a loss if they even did, because they got trapped down here, scaled in higher. And then limit orders here, 33 you could buy below, 36 you could buy below. You could buy below any bar in a bull trend, really. Using a wide stop, an appropriate stop, and then scale in, and you're going to make money. For where do we go tomorrow? The market is still continuing on really strongly. It broke straight above this resistance. So when the market's trending strongly like this, 80% of reversals fail, and all the minor support and resistance will fail. So we might have to go straight back up to a new high. We're getting high in this range, big up, big down, big up. There probably will be profit taking by the bulls fairly soon, but the bears might be hesitant to sell until there's a trendline break or at least a pullback and more sideways. The bears need a second reversal. This is too strong. So another bull bar added to the rally, closing on its high. Bad limit order sell above the bar, which makes it a reasonable stop order buy, and probably buyers below. It's a bad stop order sell signal bar, even though it might be a double top, maybe over here. Just look at the rally, the strength of it, the momentum. Look at the signal bar, buyers below. But open to all possibilities because it's a trading range. This might be a rally within a trading range, and maybe we have a rally, a pause, rally, pause, rally, pause, maybe a fourth consecutive buy climax to the upper third of a trading range. We could pull back fairly deeply. You get these breakouts in trading ranges, they get deep pullbacks all the time. Please feel free to leave questions in the comments and include timestamps for any question specific to this video. All right, I hope everyone has a good night. Thanks a lot for watching.